At this point, moving from chairman of the board of Coke to 3 CEOs in our industry, and the president of a gentleman of a company here in Atlanta, an owner, investor such as yourselves in the audience. Please welcome Jeff Higley, VP Editorial Director, Hotel News Now, and his president's panel. Jeff?
Thank you, sir. Good afternoon, everyone. Thanks for being here. Please, gentlemen, have a seat. We'll get to introductions in a moment. First of all, I want to be among the first to congratulate Bob Hunter, Lee, Teague, Nancy, and the rest of the Hunter team for 30 years. It seems like yesterday we were just at Ravinia trying to grow this thing, and certainly that has been accomplished. So again, thank you, and to those of you from the Northeast, thanks for thinking ahead and getting on those early flights and beating that snowstorm. We do have some folks who didn't make it today, including one of our panelists that we'll talk about as we go along. To get things kicked off, we're going to do a quick introduction of everyone. First, to my immediate left, Jeff Bellotti, President and CEO of Wyndham Hotel Group. Jeff, last time I saw you, you were on a stage in Berlin handing out La Quinta socks to other...
and you tweeted.
I did.
Tweetable moment.
So I'm waiting for my socks here.
This was not planned, your socks. The only person that did not take their socks was Pat Pacious, and I took Pat's back, but I did bring the other panelists' socks.
Oh, great.
La Quinta Power socks.
Wardrobe 101 here at the Hunter Conference. Thank you, Mr. Bellotti.
Pat doesn't get a pair this year. I got mine.
So, in a nutshell, give us the elevator speech of what Wyndham Hotel Group is all about these days. You did just buy the La Quinta franchise and management business for almost $2 billion, so a little bit busy right now.
Very busy, and we're very excited. We have a lot of, how many La Quinta franchisees do we have in the audience today? Oh, come on.
Got a few hands up
None?
out there.
Oh, hands.
You have, yeah.
Round of applause for La Quinta.
You're
It's a great brand.
You have a clean slate. You have many people to recruit, right?
We have the La Quinta sales team here, led by David Wilner, and all of his peeps are here. We're very excited to have acquired La Quinta. It is our 21st brand, and we're all heading out to San Diego in a few days. And the big news today, in fact, you could tweet about this, is Raj Trivedi has just signed his offer letter to be the La Quinta brand president.
Oh, great!
For yeah,
Mr.
In Raj we trust, and David Wilner and the team as well will be joining the Wyndham Hotel Group, and we're the company that operates more hotels than any other company in the industry today, with 9,100.
Tell me why you think $2 billion is worth it for La Quinta. What do they bring to the table to spend that much money?
It is, wow. It's a brand that, as you heard from the applause, franchisees love. An unbelievably consistent brand. 85% of La Quinta's franchisees score 4 stars or above on TripAdvisor. And that's a really impressive stat. It's a brand that our franchisees love. It's a brand with David Wilner and his development team that we know will continue to grow. And why, to your question, it's a great deal for our shareholders, is that when you look at why scale matters, and I'm sure we'll talk about that today as we're all growing and we're all announcing acquisitions, which I'm sure Ellie and Pat will talk about, it's never been more important, and small companies can't continue to do it on their own when it comes to technology, when it comes to systems. And when you look at the duplicative costs and the synergies that are out there with not having 2 public companies, with being able to combine the infrastructure from a sales, marketing, technology standpoint, it creates for us, from a multiple transaction standpoint, a multiple significantly lower than any of our comparable competitors are out there trading at today. So it's a great value for our shareholders.
All right, great. We'll talk more about that later. Thank you for being here. Next, we have David Marvin. David is sitting in for Ross Birkin from RLJ, who was on the runway at BWI this morning when they said, we're closed, you can't go. So he couldn't make it today. So we have Mr. Atlanta. If I'm not mistaken, David, you have 6 hotels downtown, and a dozen restaurants, so anybody who doesn't have a reservation for tonight, here's your man right there. Tell us a little bit about Legacy Ventures and what you do.
Well, we have 5 hotels downtown, and really stumbled into the hospitality industry some 20 years ago. It was really an Olympic-related play where we felt like the revitalization of downtown, spurred by the Olympics, presented an opportunity, and I say more times that we just didn't know what everybody else knew, which was that downtown was no good and was never going to be any damn good. So we invested and learned about hotels, and then 7 or 8 years ago, we got a little more ambitious and got into the restaurant business, desiring to concept exactly what we felt like our assets needed in the way of food and beverage. And then on the strength of a good experience there, got into the hotel management business. And so our signature portfolios are downtown. We have the Embassy Suites, the Glen and Autograph Collection Hotel. The Hilton Garden Inn is part of a $100 million mixed-use project that we developed. The American, which is a rebirth of the 50-year-old American Hotel in a soft affiliation under DoubleTree. And then in November, we were very pleased to take over management of Portman's Indigo Hotel on Peachtree Street. But we have many restaurants that'll be busy for the basketball activities this weekend. Stats is our flagship sports-oriented restaurant. We also have spread our wings a bit. We're about 1,200 employees strong, and we're active in Chattanooga, Tennessee, in Madison, Wisconsin, and the Corpus Christi, Texas area. So we're very concentrated in Atlanta, including up in the central perimeter area, but we're spreading our wings a bit.
You have an interesting story. You're an engineer.
I am, yes.
And you're a hotel owner, operator, developer.
Right.
How does that work? What do you think about when you look at a hotel from an engineer's perspective? You automatically go into it thinking, how can I value engineer? How can I change this? What's your approach?
Well, I think engineering, as a few other disciplines, just teaches you critical thinking, and is certainly a useful body of knowledge to have with regard to the built environment. And so important in the investment in any real estate asset is what's the basis and what's the quality of the construction. And so I think we lead with that, but of course the heart and soul have more to do with the branding and concepting and care and customer service. And I'm very fortunate to have a super team that has all of those skill sets to complement my engineering background.
Great. And we'll talk about that throughout the conversation as well. David, thanks for filling in at last minute. We appreciate it very much.
I got the call about an hour ago, so I'm not sure my tie is quite right, but...
Well, I'm sure you have a lot of fans from the Atlanta hospitality group that's out there, right? So.
Yeah, actually, and I wanted to say, I've been active, along with many of the audience, in the Atlanta Hospitality Alliance, which is a terrific peer-to-peer learning and networking organization for Atlanta hospitality professionals, investment professionals, and was really born out of the conferences like Alice and whatnot, where Atlantans would rub elbows and say, gee, we ought to get together when we're in our hometown. So terrific speakers, great talent. I'm very proud to be part of that organization.
Well, thank you for being here. Elie Maalouf from IHG. You were early on the company in acquiring Kimpton a few years ago, and that's really filled out your portfolio pretty well. Talk a little bit about what IHG stands for now, a little bit of acquisition as well as the new brand Avid that you've launched.
Sure. Well, first of all, I just want to congratulate David Marvin on joining us so quickly, and more importantly on, taking over the management of the Hotel Indigo here in Atlanta. So you're trading up in your portfolio now, your first IHG brand that you're managing. Thank you. Congratulations on that.
No commercials.
It's a terrific hotel.
It really is, and a legacy to Mr. Portman. So where are we? I want to touch a bit on, Jeff talked about scale. Last year we crossed over 1 million rooms open and in pipeline. We have scale. We don't have 21 brands yet, but we're on our way. We are over 100 countries. We crossed over 5,000 hotels open last year, just over 4,000 in the Americas alone. So we're really, we might be UK listed, but we're America big. 4,000 or 5,000 hotels are in this region. So a year ago, we had 12 brands, and that included Kimpton Hotels and Restaurants, which we acquired 3 years ago. Actually had a great year for Kimpton last year, record year in openings, 8 openings, our first in Europe and Amsterdam. And then, so our philosophy is to have a complementary portfolio from mid-scale all the way to luxury, to have scale, but scale where it matters. And what does that mean? To put it simply, you know, you don't want fat, you want muscle. And so you can just get size and just get big with size. You don't want that, especially if you're going to be in a competitive industry with a lot of athletes. So yeah, we're after scale, but very targeted scale. Scale where it matters because we want muscle. We think that in mainstream limited service, we have the skills and the scale to develop our own products mostly. So we launched Avid Hotels in September of 2017. By the end of the year, we announced in February that we had in our fourth quarter earnings that we had over 75 hotels signed, and it's still running. So that's going to follow the trajectory of Holiday Inn Express, which is today the largest brand in the world with the largest pipeline in the world, and I think the highest signings in the Americas last year. Now, as you move upstream, we've always said we'd like to have more muscle up in the luxury area where we have InterContinental Hotels. It is the biggest luxury brand hotel in the world, 230 hotels open in the pipeline. But we'd like to have something either above it or below it too, to fill out those swim lanes. Regent Hotels and Resorts came available in Asia. You know, a brand with great heritage, but I'd say in hibernation for the last couple of decades. We're going to polish it, luster it, and really bring it to its rightful place in the hospitality industry. And, you know, we have a great presence in Asia and in China from which we can build. So that's kind of our approach, really a complementary portfolio. We think we can build and develop our own products in mainstream limited service, but probably looking to acquire further in upscale and luxury.
How long did it take for you to from start to finish for that Regent conversation and deal to take place? Was that a long process? Or?
You know, I won't comment on this process in particular, obviously because we're a public company, but you know, many of these processes stop and start and go and come, and especially, you know, this was owned by private individuals. So it's sort of like basketball. You just got to hang around the hoop and wait for the ball to go your way, but you got to be close to the action and have a strategy. And our strategy has been to add and bulk up and upscale and luxury and look at all the desirable targets and build those relationships. And then the time will come, but you got to be around the hoop.
Certainly a lot of people around the hoop these days, and including Choice. Pat Pacious, President and CEO of Choice Hotels International. You just bought WoodSpring to add to your extended WoodSpring Suites to add to your extended stay portfolio dramatically. So talk a little bit about Choice, about the transactions environment, and in particular, why WoodSprings was a value for you, why you bought that.
Sure. So Choice has been around for nearly 80 years. The sort of organizing strategic focus for us is always about owner return on investment. We're the first company to have gone asset light. A lot of the other large chains have been sort of following us down that path. But when you're an asset light company, you really rely on making sure that your owners are making money. So we are a company of 12 brands, well-segmented family of brands. We are 1 in every 10 hotels in the United States. We're in 40 countries, 6,800 hotels around the world. But with just 12 brands, we actually are number 2 with regard to number of hotels. So we look for brands that can scale. We look for brands that owners want to build. And each one of our 12 brands is a healthy brand that's on a growth path of some significance. So it really gives our owners and our shareholders a fantastic investment profile. We are fairly new into the upscale space with our Cambria brand. That brand has had significant momentum really in the last couple of years, about 120 open and in the pipeline right now. And it's a complete white space for us. So from the standpoint of growth for Choice Hotels, we really see the upscale segment as a big growth opportunity for us. We were the first hotel company to launch a soft brand with the Ascend Collection, which is in the upscale segment as well. There's now 200 Ascends that are open. We opened nearly 50 last year. We'll do another 50 this year. So it's a really interesting concept. Choice Hotels has always been a company of firsts. We're the first to do an online booking tool, the first to have a mobile app, And we're now the first to put our central reservation system in the cloud. We just finished last week migrating all of our hotels onto the cloud. The acquisition of WoodSpring really was looking at a place in our portfolio where we saw opportunity. If you look at the hotel industry, the segment that had the highest RevPAR growth last year was the economy extended stay segment, and the fastest growing brand in that segment was WoodSpring Suites. So that's a brand that over the last 3 years has grown 25% in units, 21% in RevPAR, and 48% in gross room revenue. So we started looking at that opportunity and talking to the owners of that brand. It really gave us an opportunity to look at it and say it's currently at 240 hotels. By putting it on the Choice platform, we think we can grow it significantly, and we know we can help the owners drive their ROI to a place where they want to see it. It's a fantastic operating model, and the cash-on-cash returns for the owners is pretty significant. We believe by bringing it into the Choice family will help to juice the returns for the owners, as well as expand the footprint of the brand around the country.
So Pat, scale has come up a number of times already today. Can a hotel company such as yours, a franchising company, become too big? How many brands is too many brands for a franchisor?
Yeah, there's probably some point of diminishing returns, but I don't think it necessarily comes at the brand level. I think it comes from how much of and when you look at a certain market, what's the percentage of inventory that's actually sitting on one hotel platform? That's where we look at it. When we look at moving into a market with a new brand, how many additional Choice hotels are in that market, and does it make sense for us to add another brand into that marketplace? So I do think, we're sitting at 12 brands today. We don't see a lot of sort of that market saturation where we are, but I think there are opportunities if you get too big. If you're in that sort of, at some point of 30 or 40 brands, you start acting more like an OTA. The second area is focus. At a certain point, once you get too many brands, someone's going to be sort of further down the pecking order. So the question is, can the brand company continue to maintain the focus on these various brands and really make sure that they're not just driving owner return, but also keeping the brands relevant for guests?
Ellie, the same question to you, but with a little bit of a different twist in terms of creating a brand organically like Avid or buying a brand like Regent. As you grow, can a hotel company be too big? And as you grow, how do you proceed to grow further? Keith said he wanted to add another brand even this year.
Yeah.
So how do you keep growing and still keep it manageable?
I think it continues on what Pat was saying is you got to be able to dedicate, first of all, to have the resources and the scale to dedicate the right energy and the right discipline to each brand to keep it differentiated, keep it distinct, to keep it meaningful. So, I'm actually not a lifer in the industry. Unfortunately, I haven't spent 20, 30 years. I just completed my 3rd year with ISG in January. And I find it almost perplexing that I don't go to a single panel or interview where the question of, are there too many brands, doesn't come up. So I reflect back on other industries, whether it's automotive or consumer product. We just had Mukhtar Kengt up here, and in beverages or in apparel or retail. And I don't think any of them ever worry, are there too many products or too many brands or too many competitors? Look, the people that will decide whether brands are successful are right out here in the audience. If we create brands that are relevant to guests and remunerative to owners that have good ROIs, they will grow and be successful. If they don't, we'll learn that lesson ourselves and won't go anywhere. So by the discipline of that process, I just don't think the industry will have too many successful brands. Now, it may have too many brands that aren't successful, and that really won't crowd the market. But if a brand grows to scale in a market, then it must have met some customer need, maybe at the expense of somebody that wasn't as sharp, keeping their brand as significant, or must have met an owner need, or hopefully, and probably both. So I think I'm less concerned about whether the industry's got too many brands. I'm more concerned about whether we have the brands that are going to be most successful to take the greatest market share.
Jeff, what are your thoughts about that? You a big company. Can you ever get too big?
I don't think so. I think as long as the brands, as Elliot and Pat say eloquently, continue to stay relevant, continue to, for owners, drive more contribution. I mean, that's really what, you're part of systems, what the ownership community is paying us for is the lowest cost of distribution, is the most distribution at the lowest cost. And to the extent that you're of scale and size to have that operating leverage to be able to negotiate lower costs from third-party providers, from suppliers, and that brand stays relevant and does not trip over itself. I mean, what really really excited us about both the La Quinta and the American acquisition was Wyndham, as the leader in the economy space, was not playing heavily in the mid-scale space or the upper mid-scale space, where I think La Quinta belongs to be with its Del Sol prototype. To the extent that Wilner and the team, combined with Chip Olson and our sales team, could continue to push Del Sol into that upscale space where it belongs, where Wyndham isn't today, with a system and platform and size that we have to drive down costs and increase contribution. As long as it makes sense, I think we say no to plenty of brands that come along for sale that we do think are going to trip over our other brands that are going to be too many. Bob said it well when he said it really is all about the street corner, and we don't want our brands tripping over each other on the street corner, and that's certainly not what we found in the heartland of this country with American. Exceptionally consistent brand, or what we're seeing with La Quinta, which has just been on a tear, and still has, as they talk about on every earnings call, less than a third of Smith Travel Research market tracks penetrated.
Okay, so I've purposely saved you guys will have to root for David here, the owner, right? So David, you get to answer that question.
Giving the owner the last word on brands.
As always, right?
So I think I'd have a perspective that many owners in the conference would share, and I think it's a two-sided thing. On one hand, I really consider hotels to be one of the most under-demolished real estate classes out there. I mean, there is a lot of obsolescence, both physical and concept-wise, and so I think the introduction of some fresh ideas, some fresh assets makes a lot of sense. On the other hand, we do see a family of brand only delivering so much contribution, and that does get diluted as the brand proliferates. And then, the other issue that we find a bit insidious is when brands reach for their handle, honestly using owners' money, not their money, to institute certain amenities or design dimensions that are aspirational, unproven, and that end up not having an ROI. So I think new brands are a good idea, but I also think that there needs to be some constraint and thoughtfulness. And with respect, you talked about discipline. I'll be honest, I don't think that our industry is very disciplined. I think you give a developer a bank loan and a brand, and they're going to develop a hotel, right? And so we're in a favorable environment right now in terms of constrained supply, but that dynamic is birthed from the high cost of construction and the relative constraints that exist on capital. So anyway, that's my 2 cents.
That's a good segue into the current state of the industry. Now, you'll hear from Jan Freitag from STR tomorrow talking about the current situation. So there's 193,000 rooms under construction right now. RevPAR is 96 consecutive months of growth. So things are cooking along. Who wants to tackle the inevitable question of how long this is going to last? Are we going to see this for an extended period of time, or are there any storm clouds on the horizon that you're kind of looking at as a warning signal? Ellie?
Well, interestingly, I just spent my morning, and I'll spend the rest of tomorrow with our owner association board, who are representatives of the majority of our franchise owners, to really always get their perspectives. And we had Smith Travel forecast, which didn't just have growth this year, but growth into the next 3 years. So it would take us really into record territory, not just present record territory. And if you look at the underlying factors today, beyond the hospitality industry, growing GDP, maybe even accelerating after the tax cut, strong consumer spending, low unemployment, high consumer confidence. The only thing is those are lagging indicators. Those are telling us what happened in the last 3, maybe even 6 months. For me, the most interesting forward-looking indicator, leading indicator, is corporate profits, S&P 500 corporate profits. And those actually look even better. The projection this year is somewhere between 14 and 20% growth in S&P 500 profits. Much of that driven by the recent tax cut. But profits are profits. They're going to lead to more cash flow in the till of companies. They're going to pay some of that in dividend, buy some stock back, but they're going to hire more people. They're going to build more facilities. They're going to invest in capital, and they're going to spend on travel. So I think that there's sort of a second leg that's been given by this. So the forward-looking indicators are good. Storm clouds, I wouldn't say it's a storm cloud, but the one thing that I've noticed that I think we need to watch is consumer debt, especially credit card debt. That has risen back to sort of pre-crisis levels almost. We're starting to see some delinquencies, some late payments in the banks. Usually that's one of the first things that starts to trickle and go sideways is over-leveraged consumers. Corporations are not over-leveraged. The government maybe, but the corporate sector isn't, which was a problem last time. So I'd say 8 out of 10 things are looking good. That's probably the one thing I'd watch.
And Jeff, I would say, 193,000 rooms. If you look at the run up from 2000 to 2007, you go back to the 90s, the number of rooms that were added was significantly higher than where we are today. I think the lenders have been more stronger with sort of the covenants and some of the requirements around lending that hasn't let it get out of control where I think it did in sort of the peak periods of the last 2 up cycles. So I think from where we are, we're in a very sort of measured growth path. And then I looked at some pretty positive signs too. There's 10,000 baby boomers retiring every day. Those people have a lot of discretionary income, and they're spending it on experiences, not durable goods. So from the standpoint of where they're going to spend it, they're going to spend it on travel. And a lot of that's going to be leisure travel. And a lot of that leisure travel is no longer on the corporate card. So there's a lot of mid-scale hotel presence up here on the stage and out in the audience. That's a really long-term, fantastic trend because these folks do have spend. They're living longer. They're taking care of themselves more. So I do think that's from a long-term, that long sort of arc of demand, that's really going to be a real positive benefit for the industry and for our brands in general.
So Jeff, you're trying to get on a plane tonight to go back to Washington. Hopefully the airport's open so that you can go tomorrow to the Hill to talk international inbound traffic and other travel industry business as chairman of that association. What's your take on this? Is inbound travel a cloud on the horizon? Is it something we should be worried about?
It's not helping. I think you've heard all of us talk about the loss of market share, and it's become more pronounced over the last 2 years. We were on a great 10-year run up to 2015 after 9/11 of increasing that share of the international inbounds, and we were all the way up to 14% market share, not as high as we would like to be. But for the last 2 years, we have been losing share. In 2016, for the first time in 10 years, our share of the world's inbounds declined. It declined 100 basis points. And it declined again at the end of 2017 by another 100 basis points. So we've dropped pre-9/11 to the levels that we're looking at now, which could, if it continues, and we're very concerned about it, drop below a double-digit share, and it's 2 consecutive years. So there's a lot of people focused on it. Arnie's been very eloquent on it, and I know he's here Friday, and you might have him talk about it. He's been a big champion as chair of our U.S. Travel Association CEO Roundtable. But what the U.S. Travel Association is doing about it, with many other industry associations, led with Catherine Luger at the American Hotel and Lodging Association, and so many other associations in the Restaurant Association, the Retail Association, the Gaming Association. We've put together a Visit U.S. Travel Coalition, and that coalition is getting in front of the administration, trying to tell the administration that we're not winning on the international inbound game, that we're actually losing share. We think that's a message that would resonate with our president. And talking to Congress about just how absolutely critical it is for us to maintain Brand USA, which many of you have probably seen and read, has been suggested is not needed. The U.S. is the best country in the world to visit. We tell that story through Brand USA. It is costing the U.S. taxpayers absolutely positively nothing. We should all be talking to our Congress, men and women, about how important Brand USA is. when we're on the Hill, we should all be talking about how important Brand USA is, because it is one of the clouds on the horizon. Thank goodness the demand has been as strong as it's been in domestic travel to make up for that, but we need to gain back that lost share. And I'll give a shameless plug for the PACs out there. Bhavesh Patel is here, and he will take anyone's money for the AHOA PAC, and he'll give you a pin like this for $5,000, and he'll remind you that your wife could buy one too for $5,000. For all of you going to AHOA, he will be all over you next week in D.C. with Chirag. But advocacy has never mattered more. Advocacy at the state and local level, and advocacy certainly at the federal level, and it's really incumbent upon all of us in this room to support the AHOA PAC, the HNLA PAC, and the U.S. Travel PAC if you can.
Okay. David, talking about the STR numbers, RevPAR growth, we've had consistent RevPAR growth of 2% or so, over the last year or two. From an owner's perspective, how do you view that? Is there a comfort there that it's kind of settled in at that 2%, and how do you see that transpiring over the next 12 months or so?
Right. In our markets, we're seeing 2 to 3%, and honestly, we think that that's 2% anyway is really necessary to keep up with costs. So that's pretty margin neutral. We'd like to see more. But we're grateful for 2 to 3%, and that's happening with shifting demand. For example, in downtown, where we're very active, citywide business seems to be down a bit, but transient business seems to be up. So we've experienced much stronger RevPAR growth in the zone we're in now, but for the foreseeable future, we see 2 to 3%.
And for the record, Ross Birkin from RLJ said something similar, where 2% used to be you kept margins flat. Now it's really 3%. You have to keep margins flat. So I think there's a lot of consistency there. Let's stay with you, David, for a moment. Pat had mentioned guest experience being important. How important is that from an owner's perspective, a developer's perspective? When you're thinking about building a property, do you think about guest experience being the ultimate factor?
Well, I don't think you have to, but that's what we're all about. And we really would only be in the business if we thought we could deliver a terrific and often unique guest experience. That really was the driver towards us developing muscle in the F&B area. And generally where we are active is more on a full service basis. Sometimes with smoke and mirrors, where we'll develop a limited service hotel, but integrate into a mixed use project that houses that, some restaurant options and even some meeting options. But I think that increasingly, and you referenced the baby boomers looking for experiential travel, I think experiences are great. I mean, I think the days of commodity travel, at least on a discretionary basis, are over. I think it's at least what people like. So we spend a lot of time trying to create unique experiences. We were very fortunate to acquire a 50-year-old hotel from Blackstone 2 years ago downtown Atlanta that was very significant in its day when it was developed as the American Hotel, the first upscale hotel to be delivered in Atlanta since World War II, and more relevantly, the first integrated hotel, predating the Civil Rights Act by several years. And it was a hotel that was instrumental in attracting or making the Braves feel comfortable moving from Milwaukee to Atlanta. And we were able to acquire what had been run down and to breathe new life and re-energize the American Hotel. And we're affiliated with DoubleTree in a soft way, similar to the Wit in Chicago. But it's a mid-century modern design with a lot of hat tipping to some of its historic roots, and it's been really wildly popular in being received. It's all about the experience.
So the important question I have out of that, so why did the Braves move halfway back to Milwaukee then, if they were comfortable here?
That's a good question. You know, somehow they keep referring to themselves as the Atlanta Braves. It's really the Marietta Braves now, I think, right?
He said it, not me, right?
Well, I'm a downtown guy. You know, I don't. I don't suffer people leaving downtown very well.
Getting people downtown, getting people anywhere in the hotel industry, it's all about distribution, right? And the distribution platform landscape has changed so much in the 30 years that this conference has been around, particularly in the last 10 to 15. Jeff, let's start with you. Distribution platform, how would you describe it now? Is it cohesive? Is it us against them? How would you describe this whole landscape?
Yeah, I think it's very cohesive. I think things have, for all of us, especially for the three brands on stage that have scale, our ability to continue to lower our franchisees' cost of distribution, both through our ability to negotiate lower commissions, which is important, and the ability to provide more direct business through our loyalty program. Loyalty has really never mattered more in terms of driving business direct and having that booking come in for owners at the most profitable point it possibly can, in terms of that share of occupancy that's coming in through our loyalty programs being at a much lower cost with a guest that stays longer and spends up to 2 times more and has the lowest commission rate coming in.
Pat, how about your thoughts on that? Big company, big distribution platform, cloud, all that. What's your take on where we're at, where we're going?
Yeah, it's a constantly shifting landscape. You cannot just basically say our distribution strategy infrastructure is set and we don't have to look at it for the next 3 years. We look at it on a monthly, weekly, daily basis because the landscape keeps shifting. You've got new entrants. If you think about the amount of shopping and booking transactions that large-scale company like ours deals with today versus 3 years ago or 5 years ago, the growth is exponential. And what's interesting is the industry is basically sitting on infrastructure that was built 30, 40 years ago. So can that infrastructure handle the volume and the velocity of data transfer that has to occur today? And are we investing in the future? Are we investing in platforms that are going to help us grow to keep up with the Internet of Things? People are shopping today from their Apple Watch, they're shopping from their car, they're shopping from their mobile device. And as hotel owners, we have to make sure that our inventory is on every shelf. So if the customer is there, that's where we need to be. So that means pushing out your data. And data used to just be, what's the price of the room and is it available? Now data is, show me the video. What does it look like? What are the amenities? What's close to the venue? You know, those types of things. Get me some people who stayed there last night. Yes, the brand sort of description is important, but people want to know if people like themselves stay in the hotel, what kind of experience are they having? So all of that information has to be served up to the customer, and it's riding on an infrastructure that's pretty old. So as scale companies, we have the wherewithal to make those investments and make sure that we're keeping up with where the customer is going, because the customer is staying much more ahead of where the companies are able to meet. So it's not something that you just sort of sit back and say, my distribution strategy is set. You have to constantly be keeping up with it. You know, Google adds a Book Now button. That impacts every one of the people on this stage. They shifted their algorithm to a mobile first as opposed to a desktop first strategy. That changes the way you set yourself up from a search perspective. So you've got to have a talent pool and you've got to have an infrastructure that's ready for the environment today, but also where it's going in the future.
So as the disruptors come into the industry, they're taking advantage of new infrastructure that maybe the industry doesn't have in place fully. This isn't on this list of questions, so I guess I'm sandbagging you here, but where does Airbnb fit in? Should we embrace, should we be nervous, should we be scared? The fact that platforms like Airbnb are now allowing hotels to be listed and essentially becoming an OTA themselves. Is that something we should be nervous about?
Yeah, I think they started with a group of people who were sort of unlodged, meaning they were not people who would stay in a hotel to begin with. As they've gotten larger, now they're starting to attract people who want to stay 7 days in a destination resort location or a downtown urban area and have that sort of experience. What they're not providing is certainty. They're not providing confidence that when I get there, someone's there to hand me the keys, that I've got Wi-Fi, that I've got a breakfast in the morning, that I've got parking, all the things that a brand promises and delivers on. So those consumers aren't necessarily, in my view, hotel consumers. And I think that's proven out by the fact that they've grown their number of bookings to about 4 million now, but yet the industry is still riding at record high occupancies. So is there demand there that we could be getting? Absolutely. But it's been a wake-up call, I think, for the industry to sort of stay on top of providing the customer with what they want. And to some of the points that have been made up here about that experience, that local flavor, it's a lesson for all of us to learn. So I don't necessarily see it as a large threat, but it's definitely something we should take some lessons from.
Anybody else want to chime in on that?
You know, I
Ellie?
think that there's Airbnb 1.0, and I think we have to look out and say, well, where are they going to go next, right? So they've gotten to the 4 million figure that you talked about, and they've hit some roadblocks, and now they're starting to face regulation, as they should, because if you're housing people, if you're accommodating them, you need to do it with the regulation, with the taxes, and with the security and the safety procedures that we provide. And I know the industry, through the HLA and other forces, are making sure that regulation is coming, and as it should. If you're going to be in the sharing economy, you should share the rules of the road that we do. But they've built a presence, and they've built a brand name that people are paying attention to. So we have to think about where are they going next, and how can they distribute that experience in a different way? What can they learn? I don't think that is the final act. I think there's another act. And that's why we have to stay nimble and think about what is our next act. The difference is that unlike being sort of just a technology platform like they are, so they're not really invested all the way through into the hotel, into the management of the hotel. They can just move a lot more quickly. They're not making commitments to owners like you for 20, 30 years of agreements to deliver results, to deliver revenue, to deliver guests, to deliver innovation. Their owners, which are their hosts, plug in and plug out. They may have a unit on the system, but they may make it available a week a year or 10 weeks a year with no real benefit coming from that platform. So it is really a different, and in some ways more agile, but less penetrating model. It's not delivering really to those hosts and to the guests the same thing we do. So what do we have to do? We have to make sure we stay a differentiated experience. Our brands have to be differentiated, have to provide the services that the traveler, the business traveler, leisure traveler is looking for, deliver them consistently. That requires investing together, but investing in the things that provide the right returns to us and to our guests. That way we are, I think, thinking ahead to where they might go. I think we all noticed last week when they announced they're starting to add some hotels on their platform. I don't think that's a coincidence.
Okay.
By the way, that was the best Airbnb analysis that I've ever heard.
Ellie's
Awesome.
a smart guy.
That was awesome.
Former consultant.
All right, so try to top it. 30 seconds. What do you think about Airbnb as an owner?
Honestly, I don't have anything to add. I think that, the immediate is make sure that Airbnb is held to the same standard and pays the same taxes and has the same forces at play as the hospitality industry. But I think that as you think about developing new hotels, you'd better consider within your supply analysis, supply-demand analysis, the threat of Airbnb.
Yeah. So surprisingly, this time has gone really fast. We're in our final minutes or so. Let's start with Pat. 30 seconds, right down the line. What's the one takeaway you think is important for the audience to take away from this session? Pat?
Yeah, I think the focus is on return on investment. I mean, we're long-term investors as hotel chains and as brands, and owners are signing up for long-term contracts, be they franchise agreements or management agreements. So thinking not just about next week or next month, but thinking about where do you want to be in 2 to 3 years, where do you want to be in 10 to 20 years with your asset. You're making that investment in a real estate asset that will probably last you 30, 40 years. So associating yourself with someone who is really focused on that return on investment and thinking about that for the long term is, I think, one of the key takeaways.
Great. Ellie, your 30 seconds.
Yeah, look, we talked about moderate growth at best for the next several years in the top line, and so how do you amortize those costs that are rising and make sure you still have more drop in the bottom line? It's really now a game of inches. It's really a game of fractions, using the tools that we and all brands bring forward to you for revenue management, bring forward to you for direct bookings. All the bookings that you can move to direct or is more money to your bottom line? I was pleased to hear from Expedia a few weeks ago at their earnings release that they feel like their growth has been tapered off through the introduction of member rates from the brand companies. We were the first brand company to introduce member rates. Use the tools that the brand companies are bringing forward, collaborate with us, because we want to improve your top line and improve your bottom line, but it's a game of inches. It's about applying every little one of those. There's no one big solution.
Great. Thank you, Ellie. Jeff, how about your 30 seconds?
Yeah, close with the owner. Smart move. I think Bob Hunter said it best, that these are great times to be in this industry, and we are all blessed to be here. But there are, as he said in his opening letter, which I thought was very well scribed, things are changing. And to the extent that we're all aware of that, I guess my pledge would be there's never been a more important time for advocacy. And whether it's $5 or $15, give to your PACs.
Okay, great. Thank you for being here. And the owner gets the last word.
Awesome.
David.
Well, first let me say I'm honored to be on this panel with these very thoughtful industry leaders. Thank you for having me. Look, the thing that is keeping me up at night really is rising costs with the focus on people. And I think that the answer to that really, and this is addressed to the owner-operators in the crowd, is take care of your people. I think that you need to be a purpose-driven company, and you need to be engaged with your community, and you need to recognize the performance of your people. And if you provide fulfilling jobs with those attributes, I think that you stand to keep your good people, and that is going to help you manage costs, because really the most costly thing is the hiring and training and cycling process.
Very good. Gentlemen, thank you for being here, and thank you for your attention. We appreciate it very much.
Nice job, gentlemen.